Good day everyone, we're talking about the top 10 most popular dividend stocks in today's video. We normally think of following the herd as a bad thing, but can it ever help us make the best investment decisions? The 10 dividend stocks I'm about to show you today are held by thousands of fund managers and are the most popular among regular investors on Robinhood. So, why wouldn't you invest in a company that has been scrutinized by thousands of analysts, professional money managers, and investors, all of whom have come to the same conclusion that it is a buy? So, what do you think? Let me know in the comments. Is there any safety in numbers if you invest in the most popular stocks? But, like always, before we begin, make sure to keep yourself informed and engaged by subscribing to the channel, clicking the notification bell, and turning on all notifications so you won't miss our latest uploads. I look for dividend equities with a yield of at least 2.5% for our list, because if they don't pay that much, it's not a dividend stock in my opinion. I then filtered for those held by at least 2,500 money managers, leaving me with roughly 16 equities and a decent dividend stock list. The top 10 stocks held by Robinhood investors were then sorted in order of the most popular for regular investors. With its 2.76 dividend yield, making it one of the most popular in the market, Coca-Cola's dividend has only increased by roughly 3.5% each year, but with this kind of brand leadership and cash flows, it's hard to complain. Almost 3,400 institutional investors own these shares, with Warren Buffett's Berkshire Hathaway controlling nearly 9% of the corporation. Other major shareholders include Vanguard, which owns over 8% of the corporation, and BlackRock, which owns 6.5%. These are all in the ETFs administered by these corporations, of course. I was actually surprised by the value on this one, which was selling at 7.1 times price to sales. Now, it's true that consumer staples firms have a higher valuation because investors are ready to pay more for the sector's stability, cash flows, and dividend payments, but 7 times sales? That's growth stock territory. In fact, I was trying to explain the price based on sales growth or other fundamentals, but the company's revenue has been steadily declining as it consolidates its goods. Revenue has steadily declined from $48 billion in 2012 to $41 billion in 2013 and only $38 billion last year. Against this backdrop, operating profits grew from $8.6 billion in 2016 to almost $11 billion last year. So it's becoming more profitable, but it's difficult to ignore the sales decline. Analysts see a brighter picture with an average price prediction of 67 per share, or a 6% gain over the next year on top of the dividend. So, like most popular companies, we're not expecting it to skyrocket, but it will pay the dividend and possibly provide a little extra return. Since topping out in 2013, IBM hasn't done much with its stock price. However, the 5.1 dividend yield is attractive to many investors. Investors have been waiting for IBM to turn back for years, but the company's sales have dropped from $80 billion in 2016 to just $57 billion last year. Operating profit has dropped from $13.2 billion 5 years ago to just $6.8 billion last year, limiting the corporation to a 1.8% yearly dividend increase. However, roughly 2,900 institutional managers own IBM stock, with Vanguard and BlackRock among the top holders. We'll see that in the majority of these widely held dividend stocks immediately. These are the two largest exchange-traded fund or ETF providers, and many of their ETFs only invest in mega-cap index-heavy equities. What's intriguing is that Warren Buffett once had the most shares, but he hasn't owned any since 2018. With a price-to-sales ratio of barely 2 times sales, we now have a lower valuation than Coca-Cola, yet even that, it's still 22% higher than the 5-year average. I'm not attempting to spread misinformation about these stocks, especially since I know many investors own them. I'm not sure, but I think the first 2 stocks above are a touch pricey when you consider the trend in some of their other fundamentals. Analysts remain optimistic though, with an average price estimate of $144 per share for the coming year. That's about a 13% margin, and Kyle McNeely of Jefferies has a target price of $165 a share, which would be over a 30% return with dividend. Our 8th most popular dividend stock is Chevron Corporation, ticker CVX. Looking at this graph, you can see how far the stock has come. Just since the middle of last year, oil prices have risen by 70%. In truth, this firm used to pay a 5% dividend, but the share price has risen so quickly that the dividend has been unable to keep up. It continues to offer a 3.3% dividend yield. Management has increased the yield by 5.6% every year, with the expectation that it will climb by at least as much or more this year. The fund is held by about 3,400 institutional managers, including some significant holdings from non-ETF providers such as Warren Buffett's Berkshire Hathaway and Bank of America. The corporation is owned by the Norwegian Sovereign Fund, which owns 1.4% of it. With a 70% increase in shares, the value on this one should be a touch stretched. On that price-to-sales ratio, Chevron trades for 2.1 times, which is nearly 33% higher than the 5-year average. Even with oil prices as high as $100 a barrel, the cost of production is around $40 a barrel, so this is still a cash flow machine. Of course, the first stock on the list, which I own, has an average target price 3% below the current price. But that's only because this one has risen so quickly during the oil price boom. I've gained 140% on my Chevron stock since late 2020. I don't think there's much more price upside, but those dividends are only going to get bigger. So I sold some call options against it, and I am keeping the stock. Next up is Verizon Communication's ticker VZ, with shares that provide a 4.8% dividend yield, making it a potential value buy. On that price-to-sales metric, Verizon shares now sell for around 1.6 times, which is just about 4% below the 5-year average. But hey, I'll take it. Revenue climbed from $126 billion in 2016 to over $133 billion last year, a 1% annual increase that is typical of a mature industry like telecom. The issue here, as it is with many carriers and telecom companies, is the pain of last year's 5G band auction simply blasted a hole in cash flows. The C-band auction cost Verizon $45 billion, and it has contributed to a dividend growth rate of only 2% each year. Personally, I prefer telecom equities because they're finally seeing a return on their 5G investment. Revenue growth should pick up in the coming years, and this is a relatively safe industry in a downturn, resulting in consistent cash flows that keep the dividend pumping. There are 3,600 institutional investors owning shares here, including Berkshire Hathaway, which owns over 4% of the company and has invested $8 billion, as well as the typical suspects of ETF providers. Even while experts average $60 objective is just around 13% higher than the current share price, it is still a strong vote of confidence for the stock. It won't make you rich, but it will keep money in your pocket. Another company I own is Citigroup, ticker C, which pays a 4% dividend yield. More than 2,400 institutional managers own these shares, with long-term investors owning 77% of them. The dividend has increased by 26% annually over the last 5 years, but that was from a low base during the Great Recession, so I wouldn't expect that level of growth in the future. However, during the last 2 years, it has climbed by 6.5% per year, which is still good dividend growth. Now, all bank stocks have been hit hard by the recession, but Citigroup has been hit much harder because the bank hasn't been handled as properly as its counterparts. Revenue has been stagnant for nearly a decade at around $72 billion last year, despite rising earnings. The valuation is the true story here, and that's why I own the stock. Citigroup trades at only 0.5 times its price-to-book value, which is the measure you should use with these banks instead of price-to-earnings or price-to-sales. That 5-fold multiple is 32% lower than the 5-year average, making it the cheapest bank stock in the mix. In 2019, the stock was priced at 0.95 times book value, representing an almost 100% return. The issue with Citigroup presently is that it has expanded to the point where it is really difficult to manage. As a result, it's selling off a number of its non-performing consumer operations, particularly in Asia Pacific. Selling these will help it increase profitability and increase the price multiple. Analysts agree with me here, with an average goal of $71, more than 40% higher than the present price. Even the low aim is a positive return on top of the dividend yield in this case. Next up is Gilead Sciences, ticker GILD. On top of the 4.7% dividend yield, prices increased by 13%. Shares have recently fallen due to concerns about the company's ambition to diversify its therapeutic pipeline away from HIV and hepatitis therapies and toward cancer treatments. Despite this, Gilead remains one of the strongest drug company stocks. Gilead has a commanding advantage in HIV medicines, serving 80% of patients in the United States and thereby locking in cash flow. Over the last 5 years, the dividend has increased at a very healthy 7% annual rate, and over 2,200 institutional managers own these shares, with big money investors owning 83% of the outstanding shares. This is one of those corporations that is always discovering new treatments, and revenue has begun to recover from a low of $23 billion in 2018 to $27 billion last year. It is still lower than the 2016 figure of $30 billion. So far, the stock has been a roller coaster ride, with prices ranging from $84 a share in 2020 to $57 recently. However, because of the uncertainty, the company is a strong value play, selling at 2.9 times the price-to-sales ratio. This is more than 20% lower than the 5-year average. Analysts predict it to rise by around 13% over the next year, with a low aim of $54 per share. With ExxonMobil ticker XOM and its 4% dividend yield, we've made it to the last 4. With all of the rhetoric about ESG, investing, and environmental issues, you can anticipate fewer funds to purchase oil stocks currently. However, these have remained incredibly popular dividend stocks and cash flow machines. Exxon is still held by approximately 3,500 fund managers and is included in several of these thematic ETFs as well. Exxon presently has a slightly higher dividend yield than Chevron with 3.3%, but its payment has only grown by 2.7% yearly versus 5.6% for CVX. Now, some of this is due to production costs, which is why I hold Chevron rather than Exxon. While Chevron's average break-even per barrel is approximately $30, Exxon's fields are in the more expensive plays, with a break-even closer to $50 per barrel. And that means two things for investors. First, Chevron will almost certainly remain profitable, making it one of the safer investments. However, when oil prices rise, Exxon stock often produces a higher return. When oil prices rise considerably beyond the cost of production, the riskier company's stock does better. The risk dynamic is also reflected in the valuation. While investors are willing to pay 2.1 times annual revenue for Chevron shares, investors are only willing to pay 1.34 times for Exxon. Investors will not pay as much for these shares as a result of the higher cost structure and less efficient output. Exxon's present value is only 13% above its 5-year average, so it's not quite as pricey as Chevron's stock. After a 43% gain in the stock this year, experts remain cautious on the upside, as we witnessed with Chevron. The average price estimate is only 3% higher than the present price, while one analyst sees it as low as $75 per share. AbbVie, ticker ABBV, is a share I've suggested multiple times in the last year, but it's just gotten really pricey, and I hate to say that. The drug maker stock has risen 62% in the previous 6 months alone, but the dividend hasn't kept pace. Because of the high share price, this used to offer a 5% plus dividend yield, but now only pays 3.2%. What's more bizarre is that during the last 5 years, the corporation has increased dividend payments by 17% per year, but still can't keep up. That won't mean anything to the 3,600 fund managers who own these shares because they're all long-term and index investors, and the company is still fantastic, but more costly. That doesn't rule out the possibility of the corporation continuing to pay the dividend. It's still a best-in-class immunology medication company with oncology and eye care projects in the works. However, on a price-to-sales metric, the shares are 29% more costly than the 5-year average. So, those 62 returns plus the dividend aren't something I'd expect every year. Analysts are also concerned with an average target price that is 11% lower than the present price. Even the maximum target price of $192 per share is only a 10% increase. Philip Morris, ticker symbol PM, is another contentious stock that is nonetheless popular due to its 5% dividend yield. Now, when Philip Morris was broken out from Altria in 2008, the company acquired the worldwide business, so this is sales outside of the United States, particularly in emerging areas where cigarettes aren't as regulated. To lessen the risk associated with traditional cigarettes, management has established the goal of generating half of revenue from non-combustibles by 2025. Now, I'd say they're unlikely to make that target, but it's a step in the right direction, and oddly, it's that strong push from the company's heat sticks and early leadership in it that's rewarding the stock with faster growth than more traditional tobacco firms. Since 2016, Philip Morris has been able to raise its sales at a pace of 3.3% per year. compared to more than 2% per year for its competitors. Despite the popular impression, around 2,400 fund managers own it, all of whom love the safe 5 dividend yield that has increased at a 3.8% annual rate for years. Shares trade from 4.97 times, about 4% above the 5-year average, so they're not exactly cheap, but they're not as costly as some of the other stocks on this list. Over the next year, experts expect a target price of around $108 per share, up about 8% from today, with a high aim of $115 per share. This one may or may not surprise you. AT&T, ticker T, is still a popular dividend investment thanks to its 4.6 dividend yield, even if the stock has been falling over the past few years. Now that the 4.6 dividend yield has been reduced following the spin-off on Time Warner Holdings, it'll be fascinating to see if investors sell the company. It used to pay somewhere between 7 and 8%, but it wasn't sustainable. AT&T is once again a pure-play telecom carrier, thanks to the sale of DirecTV assets a few years ago, and now the spin-off on Time Warner. With the funds from the spin-off, it is paying down a large portion of its debt, and it's becoming a more focused team. After years of hating on the stock, I finally bought some shares in January. This stock is owned by over 3,000 institutional and fund managers, the majority of whom are ETF indexes and dividend themes, so they're unlikely to sell it just because the dividend yield is down a few percentage points. It continues to pay one of the highest dividend yields on the list and in the market. Due to cash flow issues associated with so much debt and the desire to reinvest in the Time Warner company, the dividend has only increased by 1.2% annually over the last 5 years. I expect that to rise now that it is a pure telecom, at the very least to the 2% dividend growth observed at Verizon. Analysts appear to be bullish, with an average price objective of about $29 per share. That's a 20% gain over the new dividend yield. How about you? What do you think? Are you buying some of these dividend stocks? Let me know in the comment section below. Thank you so much for watching. If you liked the video, please remember to like, share, and subscribe. See you guys in the next one, and remember, keep living life bullish.